that one.
Okay. Are you in, Lynn?
Yeah, I am now.
Okay, good. All right.
Thank you.
Okay, bye. Bye. Okay, people are coming in now. So whenever you're ready, Mike, to give everyone a few minutes.
Okay, so Go live. Sorry. I'd like to welcome everyone to the NCCPAP Now section on October 16th. I hope everyone is finding their own way of recovering from yesterday and has made it through to today with a newfound zeal for some information. We've lined up two of our NCCPAP speakers who will give us some additional information. First, Neil Fishman will give us an update for our organization as the national president, and then we'll go on to Steve Mankowski, our tax committee chair. I do want to make sure that everyone understands that for CPE, if you have any issues, you can contact Alex at the national office. Additionally, make sure your first and last names are both displaying correctly to receive your CPE credit. We ask that you fully identify yourself as part of the webinar. There will be 6 questions required for the CPE credit over our 90 minutes. And then if you have any questions as the speakers go through their information, we'll ask that you post that in the Q&A, not the chat, but the Q&A, which will make it easier for us to supply that information to the speaker and then also to get your question cleared. The recording of the event will be sent after we're concluded, so you have that. And if there are any issues going forward, please let us know in terms of the quality and the quality of the webinar feed, as well as the volume. For our organization, I just want to give everyone an update that there are a couple of other events that are coming up that you should mark your calendars for. Besides the webinar today that you're logged in for, next week we have a Florida chapter event, a deeper dive into AI for accountants. And then on the week of the 27th, the NCCPAP fall meetings will be occurring in Woodbury. So if you have an opportunity to mark your calendars to participate in that, either in virtually or in person, you can find more information of that on our national website. So I'd like to take this opportunity to introduce our national president, Neil Fishman, so that he can go on and give us an update on items relating to our national organization, as well as some of the other areas that we're trying to affect with this IRS shutdown. Neil?
Thank you very much, Michael. As we can see, the first polling question is up, so make sure you do answer all the polling questions so you can get your credits for today's presentation. So first of all, I also wish to welcome everybody taking the time to participate in this program today. If you're on the East Coast, good afternoon. If you're anywhere else, good morning. Congratulations on having survived October 15th. And I'm sure there are a few of us who will still have to get through November 15th, which is the due date for nonprofits that are on extension. So good luck with that. Hopefully it won't be too bad the next month. But as Michael said, next week, the Florida chapter is doing a program on AI. It's a webinar. If you haven't signed up, please do. This gentleman who is speaking, I believe, has presented before, and this is just an advance on that. And I actually think, don't quote me on this, but I do believe that there will be the opportunity to actually do some of this during the program, doing some of what he's talking about during the program. So please come, please sign up for that. It's very important. I also wish to remind everybody that the P10 renewal time is almost upon us. How the government shutdown is going to affect that, impact that, we don't know yet. So please pay attention to your emails about the renewal. I can tell you that I have had to call the practitioner priority hotline a couple of times this month. And it's still being manned. I mean, I do call at 7 o'clock. It does take a little longer to get through to a live person, but they are there. And that's important. So they're there to help us still. Hopefully the impasse will end sooner rather than later and everything will be back to normal. The other thing that I would like to talk about today is I did attend the last National Public Liaison meeting. That was back in July. They generally take a hiatus in August and September, and unfortunately, it was just announced that the October meeting has also been canceled because of what's going on in Washington. But they did give information which I wish to relay regarding data breach and identity theft. And this information is a comparison between 24 and 25, specifically July of 24 and July of 25. So for example, in July of 24, they had recorded up to 212 data breaches by firm. 212 firms have had their data breached. That was in July of 24. In July of 25, that number was now 339. That's an increase of nearly 60%. The professionals, the tax professionals, went from 661 to 842. Now that's only a 27% increase, but still, as we can see, the numbers are going up. So it is extremely vital, it is extremely important that we make sure that whatever data we have, whether it is in our offices, on desktops, on servers, or in the cloud, that we are maximizing whatever we can to protect that data so it cannot be breached. And just to add to that, taxpayers affected in July of 24, and again, this is per the IRS, it was 231,914 taxpayers that were affected by data breach and having their identity stolen. In July of 25, that number went up to 349,522. That's that's just over a 50% increase. So please, I cannot emphasize this any stronger. Make sure whatever you're doing to the max, protecting your data, protecting your clients, protecting yourself. I do believe, and Steve, you can quote, you can just back me up on this, that you can go to the IRS and put in your information to see how many returns are being prepared using your PTIN, using your ETHN.
That is correct, Neil. That's something where it's on the screen where you would be renewing your PTIN, where you'd have the ability to go in and check. The number will never totally match. There's always timings and how they may handle any rejections and such. And similar, you can go in and log in under your firm and also see how many have gone through under a firm. It only tells you based on individual returns, but it's still something worth checking, especially as we're coming into PTIN renewal season. And if I can add two other quick points, Neil. One is in relation to the practitioner breaches. Part of what we're asserting to when you do your PTIN renewal is that you have a WISP, a written written plan in the event that you do have a breach. So keep in mind that if you were, that's something that your insurance company may be asking for. They can certainly help you prepare one if you don't have one. And the other is a lot of these breaches, in my estimation, may be due to more and more practitioners at whatever type of firm doing remoting into their office and not having all of the security protocols in place, and in some cases using just the same laptop or computer that the family's playing games and doing online shopping. but also making sure that you're not using any default passwords on any of your products, including your home internet routers and your office internet routers. Thank you, Neil.
Well, thank you, Steve. Just one last thing. According to the latest information from the IRS, among active PTIN, CPAs now make up less than 25% of those with a PTIN. So make sure you renew your PTIN. I can't speak, I can only speak for myself, but this year I've already been getting calls about people looking for somebody for next year. People are looking for people who are credentialed. There will be plenty of work for us no matter what comes, no matter what happens. So I want to thank you for your time. I see polling question 2 has just come up. And with that, as we know, Congress passed the One Big Beautiful Bill. There are programs going on about it. There will be more coming on, but I'm now going to turn everything over to our tax chair, Steve Mankowski, who will give you his insights on the bill. I mean, if you looked at the original draft, that's the first one that was passed by the House. There were 117 sections to this bill, just on taxes. So with that, Steve?
All right, thank you, Neil. And the way when I was putting this together, because we all know that
Take it away.
we really haven't had anything going on over the last couple of weeks. No, tax season doesn't mean anything. We all had to worry about how we're going to be implementing HR1 into our practices and with our clients. So I know that many people have already taken whatever continuing ed courses. My objective is not to replace any other courses, or certainly not going to dwell on a lot of the various topics. As Neil mentioned, there were a lot of topics. One of the handouts that I had asked Alex to make sure that she has available in our library is one that comes from the AICPA, which is an update on a lot of the various provisions, and provides what was in the current, what had been currently done, what was in the House bill, and then what was ultimately passed in the Senate bill. It's probably about a 7 or 8 page handout, but it's certainly a good top level view as to a lot of the various topics. Obviously, with only having a limited amount of time today, we're not going to really dive into a lot of topics. And I kind of took the approach with some of this to give a little bit of background, hit some highlights of some items that are included, both individual and business. And then there were a handful of topics that I really wanted to dive into a little bit deeper. So just bear with. And if you do have any questions, there is a Q&A that is available that will be monitored, I think, by both Neil and Michael.
Yeah. Mm-hmm.
And if there's things that, as I'm going from topic to topic, that come up, Michael can certainly interrupt me and pass through whatever questions. If it's things that they can answer, they can certainly do that as well. So with that, and I just saw from Michael, the Q&A is now open. So some of these at the beginning, as we're going through, I apologize. Some of it is going to be going through what's on the slides but there will be some discussions that I'll have along with this. So One Big Beautiful Bill Act, it's officially HR1 and came into effect in July, signed by the president on July 4th of this year. And then in many respects, it is an extension or a revision to the Tax Cuts and Jobs Act that we've currently been working under for the last few years. While there's I think, as Neil said, 117 different tax provisions. There is also, that relates to about 900 pages of the perfect solution if you ever have insomnia. You can just start reading through, and if you really focus on it and keep flipping back and forth where they're just changing words in different code sections, it can certainly, if it doesn't put you to sleep, it'll certainly give you a pounding headache. And I should know, because part of what I also do besides be tax chair, I serve on the AICPA's individual and self-employed tax resource panel. And as such, we were reviewing first the House bill, and then we went back and reviewed the Senate bill and provided different commentary back into our group to then focus from there. If there's one thing that you take out of this presentation, it's really that last comment on this slide, effective date. And I have the S because if you've looked through any aspects of this bill and anything that's been generated by any of the various sources, and even as we go through with my presentation, you're going to see there is no one set effective date for this act. HR 1 has, I think you can probably say, if there's 117 different tax provisions, there's probably close to 100 varying days of effectiveness. And that just adds into a lot of the complexity. And one other point before I really go too much further, there's discussion with now former IRS Commissioner Billy Long that he had commented before he became ambassador to Iceland that he was hedging as far as when tax season would be opening for the 2026 filing year. And then shortly thereafter, they kind of pulled back a little bit because he was talking potentially mid to late February to actually start tax season. At this point, there has been no word from the IRS. A lot of the guidance that we were expecting on a lot of the various provisions was due to be released in early October. Unfortunately, as both Neil and Michael had commented, early October also coincided with the government shutdown. So while the IRS still has a skeleton crew maintaining the systems, answering some of the phone lines, they're certainly not at a point where they're doing a whole lot as far as having all the staff to provide guidance on a lot of the various topics. And also at the same point, they don't have the manpower for that. And then it's questionable how much of their IT staff is in and what's going on their part as far as coming up and getting software on their end ready for the upcoming filing season, which also then ends up affecting all of us because until the IRS has their software up and running, they also do testing of software from all of our various tax providers. So just keeping in mind, just whether you're using Intuit, Walters Kluwer, whomever it may be, their software just doesn't automatically get developed and it's good to go. They still have to go through and have the has to get tested by the IRS, and then they provide feedback, make sure that everything's being applied correctly. And that's the window that we're in now as they're getting ready to do that. So, I'm just going to start moving forward. And just some various highlights related to the individual side or personal returns. A lot of what happened, as I mentioned, relates to the Tax Cuts and Jobs Act. It made a lot of those cuts permanent. And I put maybe because there are no definites, and in the IRS world, at least as far as certain aspects of this bill go, they're permanent for the next 3 years or 4 years. There's no permanence in a lot of the provisions, just permanent in that they're not going to be sunsetting or expiring in the next year or so. There's been, in the same respect, a permanent increase to standard deduction. That fortunately was effective as of 1/1/2025, and it is indexed for inflation. So that's certainly one that's good to know, that a lot of the provisions as we're going through, you'll see that almost as a common theme, that there is a lot that is indexed for inflation. I know it's been a big sticking point. I know within a lot of our annual meetings, when we go down to DC and meet with Congress in May, we always spend a lot of time talking about, hey, these figures haven't changed in such and such a period of time. At least now they must have listened in some respects, because there is a lot of these that are being indexed for inflation. The personal exemptions that many of us loved and our clients are still harping on us about every year when we prepare the returns, those were permanently repealed as part of HR 1. There's been a temporary permanent increase in the child tax credit, $2,200 per child, and $1,700 of that is deemed as a refundable. The part that really became, you could really start seeing where this Congress is going with a lot of aspects, is that next bullet point, which is, in order to claim that child tax credit, you also do need to have a social security number. You can't just put down that it's applied for or anything in that realm. You need to have a valid social security number. And I'm guessing that if someone were to just put down a random 9-digit number and it doesn't match the person that's claimed, they will get a rejection for that. The state and gift tax limit was increased to 15 million. So that certainly helps for a lot of people who may be approaching those limits. And similar, that is indexed for inflation starting in 2026. So again, they're making steps to help improve a lot of aspects for this. Miscellaneous itemized deductions, they're the ones that we'd have union dues and all those other fund deductions. They're permanently repealed, except for the portion that relates to educators, which they have their deduction that's and above the line there, or I guess below the line for the educator, I think was $300 last year. I still say they must have a really strong lobby, because that generally equates to $60 to $70 on the tax savings. But if you do a return for anyone who's a teacher, every one of them is going to be saying, don't forget to put in my educator deduction. Wagering losses. And this is one that my ISEC committee has had a lot of discussions on, because of the way the provision was worded. You can take two different ways to look at the way that it's worded, where it's deemed as the losses are limited to 90% of such losses to the extent of the winnings. A lot of us have read that to be really no different from the current law that exists, just that you can't exceed the winnings. You can't take any more. But the simple example that we like to use is someone wins $10,000, they lose $10,000. Under the system that we currently have, that's a break even, provided that you're able to itemize. Under the new rules, you would have $10,000 of winnings and writing off $9,000 of losses because of the 90% rule. There were some that were saying that the losses were limited to 90% of the winnings, which would really end up creating even a greater phantom income. There's a number of bills that exist in both the House and the Senate trying to correct the wording and basically move this provision back to what the rules had been. Because in essence, this type of policy is really one that ends up creating someone to say, okay, well, if I'm going to end up with an extra $1,000 of phantom income, maybe I need to then lose more money, which doesn't create sound tax policy for, and certainly not a fiscal policy for any of our clients, and hopefully certainly not any of us. But it's one where there's a lot of provision, a lot of bills that are out there, and with the shutdown, that's certainly not something that's been a top priority, but it's certainly one that really need to keep in mind as we're going through and getting ready for the upcoming season. Charitable deduction for non-itemizers. This was a deduction that was created a few years ago. I don't recall the exact years that was in. Neil or Michael, if you know that, you can certainly have chime in on that. And Michael just put a note to me, remind people that there is a Q&A that's out there, and if you put your questions in the Q&A, it has an easier ability to get addressed than, because we do have people monitoring the Q&A for any questions that we may need to address. For this year, or starting for next year, so after 2025, they've gone and they've created, for someone who does not itemize, they can take up to $1,000 single, $2,000 married filing joint itemized deduction, or non-itemized deduction for charitable contributions, which is certainly nice as you're getting less and less people that are able to itemize, especially now that we have that permanent repeal of the personal exemptions. Of course, the IRS giveth, or Congress giveth and Congress taketh away. And if you do itemize, they are limited to a point where they can't exceed 0.5% of your tax contribution base. So keeping in mind, just if someone's saying, well, hey, I donated X, that's going to be one that someone may be saying, well, how come I didn't get full benefit of my itemized deductions? So that's certainly one that you really need to keep in mind. And you may or may not see that a lot. I know I have some clients that do tithing where they're donating 10% of their income. That's certainly one where they may be affected by that. The senior standard deduction puts a bonus $6,000 for periods 25 through 28. And there are some phase outs based on income. And it's certainly going to become yet another case where if you have a taxpayer who is over the 65, but a spouse is still working, they may want to factor in, because it does pertain to, that is one of the ones that is available if you file separately. Car loan interest. And I did see a question somebody had about car loan interest and an approved list of vehicles. I do believe that that's starting to exist, but I can't say it definitively. And it's one where you'd be able to deduct up to $10,000 of interest on a new car loan for 2025 through 2028. The caveat is that the vehicle must be a US assembled passenger vehicle. So does that mean that, oh wait, I bought a BMW, or I bought a Toyota or another foreign car? Well, BMW has a big plant down in Spartanburg, and a lot of the other manufacturers do assemblies in the US. And again, I'm sure there's a list that's going to be created as to what vehicles were assembled in the US. And it was certainly probably going to be one that it would be in our best interest to maybe have that bookmarked, so that if one of our clients comes in and says, I just bought this vehicle, and also we can't just assume that because they bought a US vehicle or an American vehicle, that vehicle truly was assembled in the US. So, a lot of these seem very simple, very straightforward, until Congress gets their hands on it. And Congress, as we know, can really twist and turn everything to make things a little bit more complicated. But if everything was easy, our clients wouldn't need us in order to help them and navigate through the complex tax laws. And that brings us polling question number 3. And while that comes up, I'm just going to take a quick drink here.
Steve, just one question came up.
Yes,
in
sir.
terms of the new rules for the itemized deductions are eliminated. Does that apply to trusts as well as individuals?
I do not know that answer, Michael.
Okay.
And one other one, as I see here, regarding the vehicles and the car loan, that is one that you are going to need to have the VIN and enter the VIN on the tax return or into whatever schedule that will be on, in order to verify that and that's going to be one that the IRS systems, I'm sure, will have the ability to know if that VIN if that vehicle was assembled in the US or not.
Okay. Thanks.
Yep. All right. Shifting gears a little bit over to some business highlights. One that's been a near and dear to many of us over the last few years is QBI, Section 199 Cap A. And that's one, the deduction remains at 20%, but at this point, there is no sunsetting of that provision. The phase-in range increases by 50K, single, 100K, married filing joint. Now it's at to 75 and 150. And they added a new $400 deduction for a taxpayer with at least $1,000 of QBI. So nice little bonus. And it's one where anytime that comes up on tax returns, that's one where a lot of our clients are, well, what's this relate to? Well, it's income from here, income from here. But also keeping in mind that if someone has a lot of investment income, and that they may, through their broker statement, also have 199 Cap A coming through. So they may have may not just be somebody who's self-employed or have pass-through income. They're also going to be a component that could be from broker statements. Pass-through entity, PTET. It's one we're not diving in because all the different states have their own various rules. But the PTET limitation is not affected by the SALT limitations, and we're talking about SALT a little bit later. It's still one that, and in my view, I'm shocked that the IRS and Treasury still allow PTETs to flow, because it truly is a way that taxpayers are circumventing the SALT limitations. But be that as it may, it's more and more states are looking to put that through. My home state of Pennsylvania, they've been kicking it around for a while. Nothing has come through yet. And similar to the federal government, we're still trying to pass our state budget as well. So hopefully something will come up for that. But keeping in mind the PTETs, and sometimes the hardest part of the PTETs is figuring out where inside of the software you actually enter in the taxes that were paid. Excess business losses and the limitations make Section 461I limitation permanent, and it retains the existing treatments for carry forwards of the excess business loss. Section 179, another one that we all love. Section 179, it's basically for enhanced small business expensing. Increases the maximum to 2.5 million and increase the phase out to 4 million. So a lot of good coming here, certainly a lot of ability for our clients to deduct more and more of depreciation and lower some of their current year tax liabilities. Still need to examine as far as different issues that surround that and bonus depreciation. But just knowing that these limits are being increased, and unlike a lot of other provisions, certainly surrounding 179, the fact that this has been out and existing now since July, it's certainly one that helps all of our clients that may have waited till later in the year in order to purchase various pieces of equipment, waiting to see what the tax laws are going to be. Now they know. They know what their limitations are. They know how much they're allowed to spend and expense through if they're so inclined. Charitable deductions for corporations. It adds a 1% floor, and the only contributions that are deductible are those that are above the 1% floor, and they do have a 10% limitation on that, on those deductions for the corporations. So employer provided child care credit increases the percentage to 40%, and if they're deemed as a small business, 50%. Maximum credit for the business, 500 grand, 600 for a small business. Pretty significant if it's something that your clients are looking to do. It's certainly one that can be a benefit, and certainly a nice benefit for some of their employees. And if they know that some of those expenses can be mitigated for their employees, it may make some goodwill, and certainly add some loyalty and such for your employee base. Form 1099. This is one I presented this at 2 different nationwide tax forums on behalf of the AICPA. The important things to keep in mind for the changes for this. One is that for tax years beginning 1/1/2026, the threshold goes from $600 to $2,000. And after 2026, that $2,000 figure will be indexed for inflation. Yeah, we've heard that one before, and we'll hear that one again as well. But as a side note off of 1099s, last year the IRS had changed their rules as far as if you're as a practitioner preparing 1099s for clients, it's an aggregate of 10 forms, not 10 clients or 10 forms per client. If you prepare 10 forms, you have to file it electronically. And also the IRS is going to be shutting down their fire system, which is how many of us have been uploading a lot of our 1099 information for many years. that's being replaced by an IRS system. And don't ask me what the IRS acronyms mean for both of those, but what it basically means for us as practitioners is that, one, if you're thinking of that you're going to be transitioning over to file and upload these returns through IRS, that you should start going through the process now to make sure you have your numbers in place before the IRS systems get backlogged. Again, keeping in mind any government shutdowns through that period. And also that the change in the numbers. And there's one other point that's escaping me at this point, but the sooner we can get all of those and get everything ready to roll for those, just the better off that we'll be. And certainly one to advise your clients that that was the other one. The IRS also has within their system the ability to, whether it's for us as practitioners, but primarily designed for taxpayers, to be able to enter their 1099 information right through an IRS system. And I believe they have the ability to print them and send them out to the recipients. And from year to year, that information will maintain, where you would just have to enter in the new information, double check addresses, put in new dollar amounts for the following year. It's not one that I'm really looking to do, but it's certainly one that I'd be remiss if I didn't mention that system does exist. With all the fun with 1099s, we also have an even greater fun with 1099Ks. Fortunately, this was one that, as we talked about effective dates, this is one that really exceeded anything that I possibly could have asked for Congress to do related to this. And that is, they retroactively reinstated the pre-ARPA rates from 2021, or prior to 2021, which was $20,000 and 200 transactions. Now, if you accept credit cards within your practice, third-party settlement, they're going to be sending it out to you regardless of if you do one sale for $1,000 or you do one sale for $20,000. They're going to send out the 1099K. This comes more into play with things like someone who sells tickets on StubHub and SeatGeek and all of those, Ticketmaster, as well as people that are doing and selling on Facebook Marketplace, things of that nature. More and more people are, if they have a yard sale, are accepting Venmo and PayPal and such. And now that gives them a little bit more leeway that they're not going to get a form that's reporting sales, which really would end up not being profitable anyway. But it just takes that burden away from the taxpayer, which also eases some burden on us as practitioners as well. As we were talking about depreciation, of course, we have bonus depreciation. It permanently extends and modifies the additional first-year depreciation. The allowance is back up to the 100%. And here's one that I said you really have to watch your dates. The equipment had to have been acquired and placed into service on or after January 19th, 2025. I have no idea where they came up with that date. It's certainly well above my pay grade, Michael's and Neil's all combined to figure out where that came from. But what we need to know is that it exists. And if you have someone who bought a lot of equipment and is looking to do bonus depreciation, you may just see that there's going to be varying amounts depending on if they put equipment into place before or after January 19th of 2025. And I think, oh, yep, before we start diving more in, was there any other questions that you had on your end, Michael, that you're seeing come through?
Just two. One's a comment, the other's a question on the bonus depreciation. Do you think that we'll still have issues with state add backs, which is, leaps into the other question? And, someone's asking if we're going to have additional seminars or webinars related to the New York State specific connection to the One Big Beautiful Bill. So
the best answer for the second one, and I think that's from Melanie, and that's one, I don't know which chapter Melanie's in, but that would be one that I would certainly check on the NCCPAP website, and if necessary, reach out to either the Nassau Suffolk chapter or the Westchester Rockland chapters to see what they're planning on doing. It's one where national, we try to focus more on national and more federal tax laws and changes than we do on, obviously we do advocate for a lot within different states, but the specifics for this bill is really one that's going to be much better suited to be addressed at a chapter level, I would think, Michael.
Yeah, there's certainly depth within the organization in the chapter level to try and cover these topics, especially with the year-end CPE webinars coming around.
Yeah, and also at this point, put in a plug for the annual ATS that Nassau Suffolk and the Ed Foundation put together. It's usually the Wednesday, Thursday, Friday, the week before Thanksgiving. I do know that they have preliminary grids for courses, and you could certainly look there to see if that's something that they're looking on addressing in that environment as well.
Yeah, great way to get involved.
Yeah, and it's one where a lot of what they're doing there will focus where we're focusing more on big picture and federal. They do tend to have a number of courses that may be New York, New Jersey, Connecticut specific.
Right.
So at
Thanks.
that point,
and yeah, well, we can say the same with getting specific about this bonus depreciation add backs by state.
yes. Yeah, and depending on which chapter, and I'm not picking on you, Melanie, just that I see your question there, but that's certainly one that you could certainly reach out to Alex at our national office, as well as reach out to your respective people in your chapters to see if they're looking at putting something together. And if they see that there is a distinct need for something of that nature, that may be just the push that they need to put on that program or have someone come in to give a presentation on that program or on that specific topic. And anything else, Michael? Are we good before I move on?
You're good. Keep going. Thanks.
All righty. So, state and local taxes, otherwise known as SALT. And again, here's one that the government had to keep it fun for us, an ever-changing battle. The provision retroactively did go into effect, and they very easily could have made this first half of the year, second half of the year, but it was retro to January 1st. Again, unlike the one that was effective January 19th, at least this one goes back to 1/1. And that limit increases to 40,000. Next year in 26 goes to 40,400. 27 to 29 will get a 1% increase each year. And then in 2030, if nothing else changes in the interim, it goes back to $10,000. Now, it's not just simple, hey, we increased it to 40,000. phase outs exist as well. 500,000, 505, and the same 1% increase. Bearing in mind that those phase outs cannot take that amount below $10,000. So regardless of what level you are, you won't go any lower than the 10,000, provided that you're single, head of household, or married filing jointly. Married filing separately, their SALT limitation is 50% of all of the above figures. And there is no SALT limitation, as we've mentioned before, no SALT limitation on PTET. And this is one that I know NCCPAP has been advocating for changes over the years regarding just the not necessarily the marriage penalty, but the marriage filing joint or separate penalty that exists. Dropping those in half, it just, in a lot of cases, it's not equitable. And I know I'm preaching to a large choir with this, but single, your limit will be 40 grand, head of household, 40 grand, married filing joint, 40 grand, married filing separate, 20 grand. So there's a lot of inequities that exist in that, but it's probably not one that the government thought enough to really focus on. And I guess if nothing else, we should be thankful that, provided you're not in the phase out ranges, that your number is increasing quite a bit. So, and that's certainly one that, with some of the other items that we've spoken about, this increase in SALT, especially with a number of our members being in the Northern Jersey, New York, Connecticut area, focusing on a lot of clients up in that area, it's certainly going to now give a potential for more of our clients to itemize. So just because the last several years with the higher standard deductions, that you may have just gotten into a mode of, yep, you're not going to qualify, not going to qualify. I've always taken the approach that if you have the information, I'd rather have it in my software. It gives us comparables, still see if things change. And then certainly as we go into a situation such as we're going to have for this coming filing season, where now it's increased to 40,000. In some of these areas where you have property taxes, 30, 40 plus $1,000, you're going to be, that alone will exceed the standard deduction. So it's certainly one that we really need to make sure we keep in mind. If you're sending out any end of year newsletters to clients, and certainly with any organizers you may be sending out, just make sure you're addressing this point, noting that there are phase outs, just so they don't think that, oh, wait, why am I only getting 10? It's because they were phased out of all of that. As we hit polling question number 4, and before I hit next topic, any questions that you're seeing, Michael?
Sorry, Steve. No, you're all clear.
I'm all clear. All right. Now I'm going into the next 2 topics, are 2 of, I'll just call them very highly debated, highly discussed topics that I've been hearing among a lot of friends, clients, colleagues, and was certainly one that's had a lot of chatter in my AICPA committee as well. The first part of this is going to be the no tax on overtime. And you think, this is going to be really easy to handle. Well, think again, because number one, you need to keep in mind, it's not just W-2s. There are people that may be getting paid overtime on 1099s as well. So it's not just really simple. The deduction Yeah, 25 or 12.5 for single head of household, 25 for married filing joint. And it's subject to the FLMA laws, which specify that overtime needs to be paid at a minimum of, I believe, the 50%. So 1.5 times. That 12.5 is the 50% kicker you get for the overtime rate. If someone gets double time, until the IRS gives various guidance on this, the 50% markup is what they're entitled to. Not 150%, not 200%, just the 50 that is over. And this is for periods of 2025 through 2028. There are phase outs that come into play. You don't need to itemize in order to take this deduction. There is a schedule, and it's like Schedule 1A, I think it may actually be, where this calculation takes place. The other part that I don't have on the slide is that it's not just somebody who gets paid overtime. If you're an exempt employee, you can't just turn around and believe me, we had this discussion in this committee, and one of the ladies was like, "Oh yeah, my staff's asking now if they can all be deemed as non-exempt, so that they can deduct the overtime." Doesn't work that way. There still has to be certain occupations and such that this is going to pertain to. So, and that I don't believe that has been released by the IRS at this point. But they did release a draft of the W-2 for 2026, not for 2025. And inside of there is a code that you would be putting in that's going to designate that they're entitled to get the overtime. You can't just look at somebody's last pay stub, but that's on my next slide. Married filing separately. Basically, thanks for showing up. And as we all think of the soup Nazi from Seinfeld, no deduction for you. Because if you're filing separately, you are not entitled to take the deduction for the overtime. Why they did that, I really have no idea. How do we verify the overtime? The IRS has basically said that 2025 is a transition year. We've all heard their wonderful terms, transition year. And this is going to be certainly the case for overtime and tips. And it's one where they're looking for reasonableness on the verification. So can we use a last pay stub, a letter from an employer, the employee calculation? It's one that the advice that I would give, and believe me, we've yet to come up with what the right answer is for this. We were hoping, and we were supposed to be getting guidance, I think, by October 5th, but obviously with the shutdown, that didn't happen. So, Michael, can you hop in here for 5 seconds for me?
Sure.
Thanks.
Absolutely. So in looking at the safe harbors in the IRS, if we're going into a transition year, what we're trying to ascertain is how the IRS is going to get the reporting from third parties, specifically the employers. And I think that is still, as Steve had said, to be determined. So we're hoping that there's an additional set of information still coming.
Yeah, thank you, Michael. I had
Sure.
UPS was at the door, and I wasn't sure if it was something that needed a signature or not. So, and of course, that was one that didn't, but better safe than sorry. The IRS, yes, they have put in a safe harbor for taxpayers, that if they come up and say, hey, this is what I had in overtime, and I'm sure all of our clients that are earning overtime are not just going to say, yep, I had 12.5 or I had 25 grand of overtime. They're actually going to come up with something a little more reasonable, because our clients are all upstanding citizens and nobody would give us incorrect information. At least mine don't. Michael's might.
Right.
But
Yeah, possibly.
what the AICPA in a letter to Treasury and the IRS is actually asking and provided a lot of examples, but having that safe harbor extend to tax preparers as well. That we don't want to get to a point where the taxpayer has the get out of jail free card and then they hang any of their issues on the tax practitioners, when we're relying on the information that we got it under the best circumstances we could get from the taxpayer. It's certainly one where we're anticipating that will be provided, but at this point, now your guess is as good as anybody else's. But the one thing for this category, try to use your best judgment. Our job isn't to audit the information, it's to prepare the return based on what was provided from the taxpayer. But you just may need to ask some extra questions. If they bring in a last pay stub, is that amount based on single time, time and a half, double time? Is it only the factor that's the overtime adjustment? Is it the full amount? And if they come in and they have a letter from their employer, then it's certainly one that would justify. Just make sure you keep copies of all of this in your client document management systems. We good on this one before we proceed here, Michael?
Yeah, I'm sorry, Steve. I'm saying you talked about a letter. I mean, would you think that this is just going to be one bunch of one-off forms coming from the employer?
Yes, it's one where I've spoken to reps from ADP Paychecks, and they have information that they can provide, but obviously they're just not in a situation where they're just gonna turn around and provide it to everyone without them asking.
Mm-hmm.
Because it still comes in, they can't just do a print all, because one, not everybody who's on a company payroll would have gotten overtime, and not everybody on the payroll would be deemed to be in a non-exempt function that would be able to deduct the overtime. So it's one where the unfortunate is that a lot of the information exists, just we're not really going to be in a spot where we're going to have a lot of definitive information. And some of it, unfortunately, we're probably going to be having to just take a skeptical but open view. And if a client comes in, hey, here's my last pay stub, and you ask what their occupation. Now, obviously, if they say, yeah, I'm an attorney, yeah, it's not going to work. But ask what they do and what the amount's calculated on. Just document it in your system. You can go back on if it gets questioned, and can move forward. A lot of this is going to also exist on the next topic.
Okay.
No tax on tips. Basically, same discussion as overtime. The income's listed on W-2s and 1099s. In this case, the deduction is up to 25 grand. It's effective 25 to 28. You don't need to itemize. Phase out's the same, 150 single, 300 married filing joint. And what do you know? Same thing for married filing separately. Thanks for showing up. Because the unfortunate is, it doesn't apply. And again, I don't know why, but it certainly does, unfortunately.
Okay. Any thoughts on, in terms of how this would stretch out to like a PEO?
Well, basically from a, hang on, oh, did I go too far back? The slides, Alex, are kind of stuck here. Well, I'm all the way back at the beginning. All right, hang on, just bear with me here a second, guys. From a PEO standpoint, it's still going to come down to a similar fashion, where if you're in a job that is for overtime that's deemed as being a non-exempt, and whether you're in a PEO or whatever other capacity, you're still rightfully earning the overtime. So that really would be a non-factor. One of the tips get a little bit more involved than just the straight W-2.
Right.
The IRS, as now I was able to get to the next page, released guidance on tips. They came out with a preliminary listing of occupations, and some of it really made your head spin if you actually started going through it. But their term is that they're occupations that customarily and regularly receive tips, and the tips must be qualified tips. So you ask, what's a qualified tip? Very good question, Michael. It means that it was paid in cash or a cash equivalent. And the equivalent is not just check, not just credit card, but it can also be virtual currency, NFTs, all of those things all qualify as a qualified tip. They must be received from customers, and it can't be, no, if it's a voluntary tip sharing, that also applies. But the key is voluntary. And why do I say voluntary? Because service charges and the like, you go in to a restaurant with a group of 10 people. You may see on the menus that service charge at 18, 20%, whatever the number is automatically applied on parties over this size. Service charge generally does not go to the staff. That's just more of the establishment putting that down. They can pay that to the staff if they choose, but service charge is not deductible. And the other fun one that I had to make sure I put in was that, and this is legitimate, this is right from the IRS. What also is not a qualified tip? Any amount received for illegal activity, prostitution, or pornographic activity, they're all deemed as not a qualified tip. So,
right,
good, bad, or indifferent.
yeah,
and again, some of our discussion on this started with, well, you look at box 7 on your W-2, it gives you your Social Security tips. But that doesn't necessarily mean that it was a qualified tip. Doesn't mean that it wasn't a mandatory tip. So, it'll be interesting how it plays out, because I don't think you can go into virtually any establishment that takes credit cards, and primarily your bagel place, your coffee shop, that, your ice cream place, it's not automatically trying to get you to pay a tip. So, and hopefully those get pushed down to the appropriate staff, so they are legitimately able to take those tips off if that's the case. But from our perspective, it's really the same verifications that we had on the other, which is, and one of the examples that we had, because keeping in mind, this is going to be equally as as relevant for 1099 people as it is for W-2. And you may say, well, why would that come in for 1099? And the simple is, how many of us in whatever the last period of time used a ride share, Uber, Lyft? They're all gig workers. They're all getting 1099s for their driving. You put on a gratuity on for the driver. That's a gratuity that's included. Now, Uber tends to have, and Lyft, they may spell that out, but the driver may come back and say, this is the amount that I calculated for my tip. If the driver has a calculation, you're allowed to use that number. But keeping in mind that you also need to ask questions to make sure that, especially from a 1099 perspective, that the figure that they're using for their income includes the tip. That you're not, so this way they're not double banging the tips. You don't want to say, oh yeah, well, it didn't get included on the 1099, but oh yeah, but I had 10 grand of tips. If it's not on the top, you can't turn around and take it off again. So just need to, it really, and then as you look at it, it should be included in your top number. Again, looking at how it could be affected within a state perspective, the state may not be giving the same deduction. So you would want to make sure that your gross number is truly the gross amount, not netted down already by any tips or any of what you may proceed. Also keeping in mind, you may have someone in either the overtime or the tip category. I'll use the tip for now because I'm sure a number of people that are working that receive tips, and it pains me to say this, probably aren't reporting all of their tips. And it'd be interesting if they don't realize the phase outs, but maybe their spouse is also gainfully employed, or they may have another job and they work in the local bar or whatever, part-time to make some holiday money, etc. And then they declare all their tips and then realize they're over that 150 or 300 threshold and they don't get to deduct the tips that they just claimed. So that'll be an interesting fallout at the end of tax season to really see how that came into play.
Yeah, Steve, would there be any suggestions on how to prepare those employees or independent contractors for you coming to visit us?
That's the $1 million question. I mean, hopefully throughout if it's an existing client, hopefully throughout we've already educated them enough as to what they need to prepare. But certainly it would be in our interest as well as theirs to have even a brief conversation or even a letter or email that goes out discussing, hey, just so you know, if you're doing this, make sure you do a calculation of what your tips might have been during the year, just so we have something that if you're under the threshold, you'll be able to get the deductions. It's one where when I say either send a letter or put it in an email, this way you have proof, you have verification.
Right.
If you have this conversation over the phone, how many times is it that, oh, I don't remember you saying that? That just avoids that part of the discussion.
Sure.
And, it keeps us above board. If it ever got questioned anywhere, you have verification. You have a copy of the email that you sent to this client that said, hey, this is what I need you to provide, and this is the good, the bad, or the ugly. At least this way you have verification.
Right. I appreciate that. Thanks.
You're welcome. That brings us to poll question number 5. And all righty.
Yeah, you got about 15 minutes left, and we want to leave some time with
Yep.
Q&A at the end.
Yep.
There are no questions currently in the online form.
Gotcha. Yeah, so it's the same information as we saw under overtime. They have a safe harbor, and there is the push to have that safe harbor extended to preparers. P's limitations. And I'm just going to grab a quick mouthful here before I hit this last topic. All right, P's limitations, otherwise known as itemized deduction phase outs. So with the HR 1 permanently repeal the P's limitations effective 1/1/2026. So it doesn't come into effect till next year, but it creates a new limitation. It caps itemized deductions, maximum benefits, the equivalent to 35% tax bracket. Why do we say 35% tax bracket? Because the largest tax bracket is 37%, but it limits it to 35% benefit. So all itemized deductions, sold or otherwise, yield at 35% per dollar for the top tax bracket. And it excludes the 199 Cap A pass-through deductions. But of course, the P's limitation is not without issues. So you're saying, well, it's the government. There's got to be issues, right? Of course, there's always issues with the government. And primarily what comes into play with this P's limitation is that it does not give any respect to someone who their income level puts them at the 37% tax bracket, but any portion of that income is tax preferentially treated, such as long-term capital gains, qualified dividends. They're not addressed. So you may have someone, and the one story you always hear, oh, well, this person's making X number of dollars all in, and they're paying less tax than their secretary, or less tax than their staff, because they have the dividend and the capital gain income. Well, if they're itemizing and their income level would put them at a 37% tax bracket, even though a lot of their income may be capped at 20%, their P's limitation is going to be that 35% limit. So they're going to start losing off of that, even though their income is taxed at a lower rate. So it's a complicating factor. It's certainly not an easy one to understand. I mean, when we first started looking at it within my committee, it was, well, if the majority of their income is preferentially treated amounts. And I finally got to a point after reading through some of our comment letters and said, we need to take out substantially, because that's too judgmental. It's not a defined level. What constitutes a significant amount or a large portion of their income? It's just nothing qualifies what that amount might be. And also, one person may think that this amount of dividends and capital gains is a large amount. Somebody else may say that's a small amount, or that's an excessive amount. And ultimately we adjusted our wording to just be that needs to be impacted by any of the preferentially treated amounts. And Melanie, a part of what I was covering was not looking at 401k contribution changes. That wasn't something that I was focusing on as part of this presentation. So I apologize for that.
Is that, do you think that's under, she's looking for something under Secure 2.0 or just the indexed amounts, which we can give based upon the IRS website?
I think
Either
that's
way.
something that comes more in with Secure 2.0.
Okay.
But
Which is a subspecialty to itself now.
yes.
Okay.
And before we hit any other questions, now that takes us to polling question number 6, and then also Q&A. So just as we're going through, just in as Michael's looking to see any other questions, I'll just do a reiteration. Next week, I believe the Florida chapter is having a virtual meeting with a gentleman who had presented, I believe, back in at our quarterly meeting. It was either October or
in Boca, yeah.
Or it was either October or it was the January meeting, and presented about the use of ChatGPT and some of the other AI engines that are out there. And I believe this is just the second round of that.
Wednesday, October 22nd at 9 a.m.
Right. The following Monday, Tuesday, Wednesday of October, the 27th, 28th, and 29th is our national meeting up in
Woodbury.
Fox Hollow, up in Woodbury, New York. There is a part of that is a night out with NCCPAP where hors d'oeuvres, beverages, and just a chance to socialize and network with other NCCPAP members. One of the days, I think probably that same 28th, is also what's truly the national meeting, where the incoming officers all get sworn into their positions. And it's really a national meeting where we review board minutes from the prior meeting, and it's much more formalized prior to that. So if anyone's up in that area, it is something I do believe is free to attend. There may be some fee either for lunch or continuing ed, although I'm not. Alex would certainly know more on that, and you may see that on the NCCPAP website as well. There's two dates in November that will be having the annual blank room tax updates. One is in New York, one in Philadelphia. The registration, if it's not open yet, should be open very soon. And NCCPAP will be doing a presentation during those two meetings. I think Neil's going to be doing the New York. I'll be doing the Philadelphia. And the first Monday, Tuesday, Wednesday of January is our winter quarterly meetings down in Boca area. Always good to get a little bit of warmth and recharge the batteries before we come into 1099 W-2 season and whatever time the tax season will start next year. That just covered some of the housekeeping. And now I forgot probably what some may consider the other important one during that same period of time. The Wednesday, Thursday, Friday before Thanksgiving, again, ATS also up in Woodbury at
Crest Hollow.
Crest Hollow. I know it's something, but up in Crest Hollow, that's a separate registration. For those 3 days, you can do 1 day, 2 days, or all three. Certainly, it's one that you can get a lot of continuing ed. They'll have a vendor hall for a couple days and just a chance to meet and socialize with other NCCPAP members and get some good quality continuing ed as well at the end of the calendar year. Anything else that you see coming that may have come in? If anybody after this presentation, if you have some other questions, you can certainly feel free to flow them through the national office. Reach out to Alex. She will make sure that whether it's from a data security end or any of the topics we discussed here during my presentation, and we can work on getting back to you with answers. I know that Alex had commented that the slide should be up momentarily or some point this afternoon. Some of that was that with the end of tax season yesterday, I was working last night and diligently this morning to finalize my slides, because now unfortunately some of my clients got me stuff at the last minute as well.
The
So-
slides are up, and so is the document from the AICPA for the tax provisions.
Excellent. Thank you,
Those
Alex.
are both in the library. The recording after we're done will be eventually available once we upload it. But yeah, the slides and the additional supplement documentation that Steve had mentioned is in the library.
Perfect. Thank you, Alex. And at that point, I think we've hit all of our polling questions.
Yes.
And unless there's any other residual questions, I know we've certainly hit more than our allotted time with the 50-minute hour. And unless you see anything otherwise, Michael, we can get people an extra 4 minutes back in their afternoon.
No, just a big thank you to both you and Neil, and obviously Alex at the national office for going through all of this. It's a huge topic. Neil for his continued leadership of the organization. Steve for your participation in many different levels and being available to members. So thanks very much. And again, if there's any follow-up or additional questions, please let us know. And that includes any excitement on your part to get involved with the organization.
If I would like to thank everybody for attending. I hope to see some of you the week after next at the national meeting. And if I don't see you then, hopefully I can see you at the ATS program the week before Thanksgiving. Please come up, introduce yourself to me, talk with me for a few minutes. Let me hear what you think about NCCPAP. So on behalf of Michael, on behalf of Steve, thank you all for attending, and we'll see you soon.